Have you noticed a change in your credit application approval rate recently? It's not just you. There's been an overall decline in credit applications across the United States. To put it into perspective, we're talking about a drop of 3.6 percentage points from the previous year. Now, it's not all doom and gloom. There's been an upswing in applications for auto loans and credit cards. But here's the kicker. The rejection rate for these applications is at an all-time high. It seems like the doors are opening, but they're being slammed shut just as quickly. And let's not forget about mortgage loans. Applications for these have hit an all-time low, and we're seeing a large decline in mortgage refinancing as well. It's as if the whole landscape is shifting under our feet. But what's behind these changing trends? Let's delve deeper. To understand these shifts, we need to look at the broader economic landscape. It's no secret that the world economy has been on a roller coaster ride due to the pandemic. This instability has had a ripple effect on consumers' financial behavior, making many more cautious about taking on additional debt. With job security less certain and the future unpredictable, it's understandable why people may be less inclined to apply for credit. The notion of adding another monthly payment to an already tight budget can seem daunting. This general sense of financial insecurity has likely played a significant role in the decrease of credit applications we're witnessing. Another contributing factor could be the increased regulatory scrutiny on banks. For instance, Capital One recently eliminated overdraft and insufficient fund fees, indicating a shift towards more consumer-friendly practices. This change may have discouraged consumers from applying for credit, as they might feel uncertain about how these new regulations would affect their financial obligations. On top of this, we're also seeing a change in consumer priorities. Today's consumers are not just looking for credit, they want a comprehensive user experience. They value features like cashback rewards, data privacy protection, and credit-building tools. If these features are not offered or emphasized, consumers may be less inclined to apply for credit. All these factors, from pandemic-induced financial instability to changing consumer priorities and increased banking regulations, are reshaping the credit landscape. Now that we've understood the reasons, what does this mean for you as a consumer? These trends have profound implications for consumers. With a higher rejection rate for credit card and auto loan applications, individuals may find it more challenging to finance essential purchases. This could lead to a shift in consumer behavior, with more people turning to savings or seeking out alternative financing options. The auto industry could also feel the pinch. If prospective car buyers struggle to secure auto loans, we might see a downturn in car sales, affecting not just consumers but manufacturers and dealerships as well. Now let's turn to the housing market. The decline in mortgage loan applications and refinancing signals a potential slowdown. For those looking to buy a home or refinance their existing mortgage, this trend could mean facing higher interest rates or stricter lending standards. But it's not all doom and gloom. A slower housing market could lead to more negotiating power for buyers. And for those who can't secure traditional financing, it might be the nudge they need to explore other options like buy now, pay later services, which have been steadily gaining popularity. These shifts in the credit landscape will inevitably influence financial planning and decision-making. Consumers might have to rethink their strategies, adjust their expectations, and stay flexible to navigate these changes. While these trends may seem daunting, being informed allows you to make the best decisions for your financial future. In a rapidly changing financial landscape, staying informed is key. Today, we've unpacked the current state of credit applications in the United States. We've seen a sharp decline in overall applications, particularly in the realm of mortgage loans. We've also noted an uptick in applications for auto loans and credit cards, albeit met with an all-time high in rejections. These shifts are largely a response to the evolving economic conditions and consumer behaviors. The implications for consumers are significant, affecting purchasing power, borrowing options, and financial planning. Keep a close eye on these trends as they continue to evolve. After all, knowledge is power when it comes to managing your financial future.